Guys, 3 companies at 52-week lows. 2 of them I love, and I'm going to buy them soon. The third one, a little bit tough, but let's get into it now. First stock is Nike. Guys, look at Nike. $93.60, all-time high of $179. It's almost a 50% drop from all-time high. If I had told you that a company like Nike would have been down almost 50% in the last, whatever all-time high was, November 5th, 2021. So it's been almost 3 years, 2.5 years since it's been at this all-time high, and it's done nothing but go down. How would that have felt? It'd been hard to feel that. Be like, no way that's going to happen. This company's not going to fall. We hear it all the time. But Nike is a great company, great apparel business. I think it has a great hold on the marketplace. And here's some stats I'm going to show you that prove that. Now, obviously, Nike dominates the footwear market. Guys, this is Nike against Puma and Adidas. Going back from 2010 to 2022, their annual revenue just based on shoe wear. Just look at this growth on Nike. If you look at Adidas, it's up, but it's been declining lately, and Puma has been making a surge. Even Puma has started getting into the basketball shoe market to compete with Adidas and Nike and all these guys. But guys, Nike dominates this. Nike is, look at this. The other two combined do about $18 billion. In 2022, they did $29 billion, over 50% more than the other two combined. Does that mean they're going to stay that way forever? No. But they've got such a hold on the footwear market. They've got Jordan. They've got LeBron. Need I say more? Literally, need I say more? Side note, LeBron is the GOAT. However, there's more having to do with Nike, even on the apparel side. Let me show you. This is Nike against Puma and Adidas on the apparel side in terms of revenue. Not as strong as on the shoe side, but still more than the other two combined. It's about $12.4 billion. The other two combined, and they're at 13.6. All right, so Nike's still dominating there and still has a nice upward trajectory on their apparel business. Now let's go through a few other stats before I get into some more information. All right, so the company has a market cap of $142 billion. That means if you bought all the shares outstanding, you're spending $142 billion. Enterprise value, $155. That difference there is essentially the debt net of all cash of $13 billion. And guys, their free cash flow last year was $6.2 billion. Last 5 years is $4.5. They can easily afford this. Easily afford it from a debt ratio compared to their free cash flow. They have a 1.5% dividend that eats up $2 billion of their free cash flow. Now, guys, keep in mind, we like the fact their dividends paid is less than half of their 5-year average of $4.5 billion in free cash flow. Now, another thing I love, Nike's gross margin, 44.3. Now, if you've noticed lately, Nike's trying to sell more and more direct to consumer. In fact, these are the number of stores that Nike owns globally. As you can tell, it is actually declining. It started at 674 in 2009 and gradually grew, and now it's on its downtrend. My guess is Nike's probably going to keep slowing that down. They've already pulled a lot out of Foot Locker and other stores. They're going to try to go direct to consumer with more customization. This allows them to have a higher gross margin. So speaking of gross margin, let's see if there's any difference in their gross margin as of late. Now, this is Nike's gross margin going back to 1990. As you can tell, a little choppy here, but in the last 10 years or so, it's been pretty consistent between, let's call it 43% and 46 or 47%. So it's very consistent in that range. Does that mean it can't go higher? No, if they're manufacturing their own stuff and doing direct to consumer, remember, gross margin is basically taking your sales, your revenue, and taking out direct costs. So that would be things like direct material, direct labor, shipping, any taxes they pay, some direct marketing costs would be part of that as well. Okay, so that says that they get 45% of every sale can go to the bottom line. Well, let's go to pay overhead before bottom line. Okay, now speaking of bottom line, they've been pretty consistent. The last 5 years, their bottom line profit margin has been about 10.7. Last year, 10.1. So they're selling for 27 times last year's earnings and 23 times last year's free cash flow. Is it a lot? Well, I don't know, because Nike, guys, I believe Nike is a moat. And we're looking at the 8 pillars here, and the only X's we have are the 5-year PE and 5-year price of free cash flow. I think Nike deserves a premium. The historical average for PE and price of free cash flow over 1 year is 15. But shouldn't you pay more for Nike? This is a high quality business that has a lot of staying power. Imagine a world 10 years from now that Nike didn't exist, or that Nike was a fraction of what it is today, or somebody else is overtaken. It's not impossible, but man, they have such a stronghold. And they have Michael Jordan for life. They have LeBron on a lifetime contract. And they're going to keep adding more people as time goes on. Guys, under the Nike brand alone, not including the Jordan brand, just the Nike brand, we got LeBron, we got KD, we got Giannis, we got Ja Morant, if he stays out of trouble, we got Devin Booker. Now, under the Jordan brand, you got Chris Paul, Zion Williamson, Luka Doncic, and Jason Tatum. These are huge players. I mean, look at the Jordan brand. Zion, Luka, Jason Tatum. These guys are young. These guys have a lot more basketball to play. That's what's incredible about them. Devin Booker, huge basketball potential. This guy's just getting started under the regular Nike brand. They have control of the basketball market, and they're going to still stay aggressive. And forget about basketball. Yes, they've exited golf, but they're huge in tennis, and they're growing even more in college sports. In fact, my alma mater, University of Michigan, was the first team to sign with Jordan brands for their football team. So there's a lot of potential out there for Nike going forward. And there's still a lot of international stuff to do. Soccer teams are growing, basketball international, baseball international, football international. There's a lot of potential here. So let's see what analysts are saying for this potential. So guys, earnings per share. Analysts expect $3.62 this year, growing to $6.33 in the next 4 years. That's double-digit growth every single year. And again, guys, it's analysts. So you got to be a little questionable of their motives and incentives, but still, it gives you some sort of guidance. And their revenue increases $52.3 billion to $71. That's growth of 6, 8, 10, and 7. So high single-digit growth, which, guys, we don't need 20% growth to make a good buck. You just need to pay the right price. Now, remember, the reason I like looking at 52-week lows, it's a good place to start to say, where has the sentiment shifted on a company? Because remember, news follows the stock price. And this is a company, Nike, right here, where if you bought it at the top right here of 179, you're probably like, oh boy, what's going on here? Guess what? Whenever you buy a company, you're not going to buy it at the bottom. It's going to be very rare for that to happen, okay? The big key in investing is this. You have to have the right fundamental process coupled with the right emotional mindset. I used to think it was 90% fundamentals, 10% emotion and mindset. I was wrong. It's flipped. If I had the Albert Einstein of fundamentals there and they didn't have the emotions, they're screwed. They're not going to do well in investing. You're going to see your stocks go down because the market has shifted. News follows the stock price, not the other way around. So even though the fundamentals are getting better on Nike, I guarantee the sentiment out there is negative on Nike because Mr. Market is telling you this stock is worth half. But is it really worth half? Of course not. Nike's going to be around for a long time, and they're likely to drive their revenue and profit for a very long time in the future. So if you pay the right price for the company, you can then sit emotionally and sit there and say, I like Nike through the ups and downs, and let it watch it run and compound on itself and make you more money. Every great investor in history has learned through heartache, I'm not saying I'm a great investor, but like I am, like I have, like Warren Buffett, like Charlie Munger, they've learned that buying good businesses at good prices can compound and make you a lot of money a lot easier. It's hard to see a company fall. You get worried and you're out there all alone sitting there saying, is the company going to zero? Look at all the bad things out there. News is better when it's bad. That's why I created this community. I wanted a place where like-minded investors could go and talk. Thousands of them in the community talking every single day. And when they're worried, they have conversations. They understand what they're buying and why they're buying it, and then why they're holding on to it. The key to all successful investing is good emotional mindset, and that is learned over time. And that's why the community is here. So if you want to start making less emotional decisions that'll help you make more money and sleep better at night, click the link below, sign up for our community. Guys, we have a wait list coming soon, so make sure you sign up before that wait list starts. You might be waiting a little bit before you get in. It's $7 for 7 days. It's a no-brainer, so go check that out. So guys, now the question is, what's the right price to pay for Nike? So let's pull up the last time I did Nike in our stock analyzer tool history. Makes it nice and easy there. All right, guys. 10-year analysis. I have a low, middle, and high assumptions all the way down. For my revenue growth, line number 1, 3, 5, and 7%. The 5% actually might be low. But I'm okay with that. I want to be a little bit conservative, but not over the top conservative. Profit margin, very consistent. Look at this profit margin. 10.4 over the last 10 years, 10.7 in the last 5 years, 10.1 last year. I actually put 10, 11.25, and 12.5. Now, I'm actually going to change that to 11 because I do believe they can still get a higher margin, but I don't want to bank on that necessarily. And I'm going to keep the same thing for free cash flow, 10, 11, and 12%. Okay. Even though they've been a little bit higher in their earnings versus free cash flow, but it's not astronomical. Now, what is the PE and the price of free cash flow that you think Nike should sell at in 10 years? Well, market average is 15. But I don't think Nike deserves a market average. I think it deserves a premium. What's that premium? That's the art of investing. Everybody has a different opinion. In our next company, I will talk about that and what I saw on the internet. And I look at this going, okay, I think Nike is all day at 20, high side 26, middle 23 multiple. I'm okay paying that much money for Nike. And finally, my desired return. What return do I want? Well, I put 9% in here. That's basically the market return. Now remember, this has no margin of safety, and you need margin of safety because valuation is an imprecise art. We don't know the future, and for humans, we make mistakes. So these prices that come up are before margin of safety, but you might be okay making 9% and owning Nike. So I hit the analyze button. My prices are a low of 61, a high of 120, middle price of 86. My watch list price is 85. When it hits 85, I'm going to start selling puts at lower prices. Stock number 2, Starbucks. Starbucks, guys, great company, 85.69, all-time high of 126 back in July of 2021. So again, over 2.5 years, almost 3 years, and we haven't seen an all-time high yet. This company has an amazing return on invested capital. That means they get a high return on the money that's invested in the business, high dividend yield compared to the market, 2.5%. They have free cash flow of $4.4 billion, 5-year average of 2.8. But here's the deal. Their dividends eat up a lot of that 5-year free cash flow. So it's a little high. Now, if this free cash flow over the last year can sustain and keep going, then that should be okay. It's still over 50%, but as they grow it, that could be fine. Now, I still believe Starbucks has a lot of growth opportunity. Another thing I like about Starbucks, last year, their same store sales were 8%. What this means is stores have been open for 12 or 18 months or more. They still grew 8%. Because remember, guys, you can open 1,000 more stores and increase revenue that way. But if every store that's existing open declines in revenue, you're masking the problem. That's why you look, whenever it involves a lot of locations, same store sales. Now, in a 10K, if you're reading the 10K, it's oftentimes called comparable store sales. So look for those in a 10K as you're reading them. And don't forget, on our software, you get the 10K right here at the bottom right, hit annual reports. It takes you right to the SEC website for Starbucks, and you go from there. So here's some stats on Starbucks. First off, their gross margin, just like we looked at Nike. This is going back about 10 years. Guys, it's ranged from 21% to a high of 31%. That's a big range. But their average has been right about here, 28%. Okay, not bad, maybe a little bit lower than that, but that is their range in terms of gross margin. And gross margin is going to drive a lot of the profitability. Now, here are these stores by country. United States is the most right here, 16,346. This is Starbucks store-owned stores. These are the licensed stores. China, 100% are all Starbucks owned. Canada, the vast majority. Korea, Latin America, all licensed deals. Japan, all owned by Starbucks. My guess is you need to figure out what's the profitability based on a licensed store versus Starbucks owned. My guess is a Starbucks owned one has a higher profitability to the bottom line, higher gross margin on the licensing. But that'll be interesting to see. What is their plan going forward? Is it going to be more corporate owned or is it going to be more licensed? But I also want to make note, there's a lot of countries here that are still expanding their footprint in the world and getting wealthier and wealthier, and Starbucks will be there. I'm interested to see how many Starbucks are even in Africa. So, guys, this is Wikipedia, and it's February 2024. Egypt has 66, South Africa has 54, Morocco 9, Tunisia 1. That's a total of 130 stores in Africa. Guys, how many people are in Africa? They're going to have a lot more stores as the economies grow in Africa, a lot more potential there, and they have an established brand that they can go build on. All right, guys, let's go check some other things out on Starbucks. Look at this revenue growth over the last 8 or 9 years. 19.2, 21.3, 22.4, 24.7, 26.5 fall during COVID to 23.5, 29, 32, and 36. Some major growth lately. This company is still growing, and it's such a big company. So many store locations out there. Now, let's look at the 8 pillars. All right, a lot of debt. I'm okay with that. It's retail locations that are primo locations. I'm fine with that. I don't even worry about this. But the 5-year PE and 5-year price to free cash flow, remember, they're growing their cash flow and earnings quite a bit. So that's going to fall very drastically. Now, what are analysts saying? So like I said they're going to grow their earnings a lot. Expected $4.20 this year. Hey, yo, $4.20 up to $8.04 over the next 4 years. It's almost 100% growth in their EPS over the next 4 years. And look at that, 19, 17, 16, 20, 17% growth in earnings per share, according to the analysts. And for revenue, actually high single digits, 40.2 billion to 59.16. High single digits. Now, again, these are analysts, so keep that in mind. But let's see what StarBucks is worth to us right now. So we pull up StarBucks. Last time I did it, I like these assumptions, guys. I'm not going to talk all the way through them, but you can pause the video and check them out on your own. But I have a price on the low side of 67, high side 140, middle price 100. Is that enough? Is that enough a discount? $99 versus the current price of 85. It's a 15% discount to my intrinsic value. Not necessarily yours, but mine. That is part of the art of investing. It's on to you to decide what's the right thing for me. What's what am I willing to pay for this company? Stock number 3, Apple. It's at 168 after an all-time high of 199. Guys, the 52-week low is 161 or 162. So we're within 5% of that 52-week low. So please pay attention to this company. Apple was just overtaken again by Samsung. Samsung held the number one phone maker in the world for 12 years, lost it to Apple last year. Apple has now had a decline in their sales. Samsung took it back again. So this back and forth, not really back and forth, Samsung dominated for 12 years. So that's the key here. Now, I look at Apple and I look at this, ready? Free cash flow last year, $106 billion. Jesus Christ. Guys, how many companies even generate $106 billion? How many companies are even worth $106 billion? They generated $106 billion in free cash flow last year. The last 5-year average is 90. So you see, there's not a lot of growth in that free cash flow. However, if you look right here, 45% gross margin. They're starting to do more on the services side of their business, trying to grow that part. As they grow services tend to be high margin. Why? You don't need to make a product to do a service. It's more of it's a service. So you can do it on the internet, and the margin's very, very high. So my guess is it's possible this 45% is dragged down because of hardware. Actually, that's well known. And it's possible this continues to increase as services are a bigger and bigger percentage of the company revenue. So as I was saying, look at the last 10 years. This is the gross margin on Apple over the last 10 years. It started out about 38%, and it's all the way up to 45%. Now, let's go check out their services revenue as a reflection of their overall revenue. In 2013, iPhone sales, $91 billion, services, $16 billion. 2014, 102 to 18. Let's just focus on services. 16 billion, 18 billion, 20, 24, 30, 37, 46, 53, 68, 78, 85. It went from about 17 or 18% of sales to now it's 40%. So how does that compare to overall revenue? Well, let's go take a look at overall revenue for Apple and compare it. Back in 2013, we're going to pull up the income statement. In 2013, total revenue was $171 billion. And their revenue here in services was 16 out of 170 billion, call it 9%. It's a little over 9%. Okay, not bad. Now, 2023, 85 billion. And what was our revenue in 2023? $383 billion. So 85 divided by 383 billion is roughly 22 to 23%. Let's get the exact number out there. Please hold. The exact number is 22.2%. So it has increased quite a bit. And these services, like I said, are going to add more to the bottom line for Apple. As you know, Warren Buffett and Berkshire Hathaway own Apple and been buying it as time goes on, as the price makes sense. So the question is, what is the right price for Apple? Let's go take a look at analyst estimates first real quick. Look at this. For this company, they're still showing $6.73 to $10, still high single digit, low double digit earnings per share growth. Okay. Revenue growth, I'm actually surprised to see this. They're showing all over the board between 3% and 13% over the next 5 years. So, what's Apple worth to us? Well, I'm going to check out my stock analyzer tool. I'm going to pull up Apple. Now, again, before I get into the numbers here, they're back here right now. Check them out. Remember, guys, the fundamentals will get you into a company. The emotional rides will keep you in the company so you can compound. And you need to be able to handle those emotions. And that absolutely can be taught. And especially if you're in the right community of people. Show me your friends. I'll show you how you're going to turn out. So if you want to be a stable, emotional investor, click the link, sign up, $7 for 7 days, get there before the wait list starts. Here are my assumptions for Apple. I'm going to change this a little bit. I'm going to go 3, 7, and 11%, even though I think that's absurd for 11. My prices here, a low price of 90 to 105, high price of 275 to 300, middle price of 157 to 173. Again, no margin of safety. Right now, you could actually buy it if you want to make a little bit better than the market potential of 9%. But guys, thank you very much for your time, and watch the next video on the 33 companies I want to own in my portfolio.